I want to talk a little bit about how this now affects our economy, the real economy, not just the financial side. So what we had over the last couple of weeks and months, as Dick mentioned, we had a crisis that has brought a shutdown basically in the availability of credit, of markets between banks, lending markets between banks and small businesses, banks and large businesses. In addition, for the real economy, that housing bubble burst that John just mentioned has led to a marked slowdown in the construction sector, less investment there. So now what you've recently seen are that orders for durable goods are down, car sales are down 30% for Ford and Toyota, for example. Retail sales announced today are down 1.2%. So you're seeing these feedback effects now, not just in the financial market, but now spilling over into the real economy. So what that means is basically you have some job losses. The unemployment rate have gone up already to over 6%. You have more trouble maybe because of that for banks. People that are losing their job might have a harder time paying back their mortgage that they might have. That car salesman that sees their sales decline might lose their job. So that's one of the effects on the U.S. economy. But also remember, it's not just a problem for the U.S. economy, rather it's an international crisis. You saw big rescue packages in the same vein as the U.S. had in Europe, spearheaded by Britain, Germany, France, other countries in continental Europe have similar problems to the U.S., although maybe at first they didn't realize the depths of their issues. So you already have those economies of Britain, Germany, and France, and Italy already contracting or at zero growth. So they might be already further ahead in that recessionary environment than the U.S. might have been due to that stimulus package that brought up the second quarter growth rates in the U.S. And you have a financial crisis in Iceland, for example, where the tiny nation of 300,000 people had to nationalize their three biggest banks, who had shut up their debt to GDP ratio, so their overall indebtedness basically. That makes a risk of maybe a sovereign crisis that Iceland might not be able to pay back their bonds. Hungary, another country in Eastern Europe, is facing pressure. You've seen that Mexico and Canada, our next door neighbors, have seen rather large depreciation of their currency as capital seems to be moving out of these markets for a flight to safety to the U.S. People want to buy U.S. bonds, so the dollar kind of paradoxically has appreciated over the last couple of months. That might also mean that as opposed to in a recession that might just hit the U.S., it's not easy for us to export ourselves out of that recession. Through a depreciating dollar, spurring up export demand from other countries, that might not happen as if it were just a recession that's isolated in the U.S. So, and also, I mean, you've seen the Russian economy being hit by other factors. So it's definitely an international phenomenon, this crisis presents. So how do you get out of it? Well, eventually, my guess is you get out of it in a similar fashion as you got out of previous recessions. You have low interest rates. The Federal Reserve has to worry less about inflation rates, with oil prices coming down, thankfully. They can keep interest rates low. Ultimately, that should encourage investment and in some other sectors. So after the 1980s recession, maybe it was the financial markets that drove the economy forward again. Maybe after the 1990 recession, it was the changes in communications technology and the internet that drove the economy forward. Maybe it was the construction sector, the housing bubble that John mentioned after the 2000 recession, these low interest rates that drove the economy forward. So something like that is likely to happen after a recession that I think is going to be severe in the sense that unemployment rates will go up further, up to maybe 8%, maybe more next year. So remember, we're at 6% right now. So that means a lot more job losses maybe in the future. That might mean less of bright job prospects for graduates. If you're a student graduating this year or next, you might have a tougher time finding your first job than you might otherwise had. But maybe, and we'll talk about that more, with that increase in possible regulation, the public sector being more involved in financial markets, if you're interested in a job in finance, look to become a regulator. Look to get your first job. Look that maybe you can get your first job at there's new regulating agencies that might come about. You might also be in high demand a couple years down the road because you understand that new regulation better. So not all is lost. I doubt it will see anything like another Great Depression, as some people seem to suggest, of high unemployment rates going into higher than 20% range or whatever. But it will be probably a recession as bad as the one in the early 1980s that I personally didn't have to live through. I was 5 years old at the time, but some of you in the room might remember.